when the market is coming down, then there will be comments like, oh, but I'm afraid of investing in it. If I invest, maybe I might lose money. So to such comments, Alvin, what would you have to say?
Don't invest, huh?
Don't invest. Struggling to keep up? Welcome to the FOMO Fix. Welcome back to the FOMO Fix. In this episode, we're going to dive deeper into the China markets. With its massive economy and explosive growth in industries like tech and green energy, China has become one of the most talked about markets in the world. But how can you gain exposure to such markets without feeling overwhelmed? And what are some of the key areas to keep in mind of when investing in such a market? Hi everyone, I'm Hazelle from the Joyful Investors, your navigator on this journey to financial empowerment. Joining me today are Alvin, Chow, and Constanz Wee.
Hi, I'm Alvin. I'm an SIAS Academy trainer. I'm also a co-founder of Dr. Wealth, a financial education company.
Hi, I'm Constanz. I'm a university student and I have 3 years worth of investing and trading experience.
Alright, so we all know that China's economy is huge, right? So, but Alvin, could you begin by briefly sharing with us why should beginner investors be paying attention to the China markets at this moment in time?
I guess because even based on our own experience, if we look around, it's inevitable that we will see that there are a lot more Chinese companies coming here. There are a lot of shops opening up, right?
Yes.
Probably like, I don't know, 1/3 of the mall is Chinese brands.
Yeah,
right?
more and more.
Yeah, so this is a sign where a major economy is starting to export their influence, export the scale of their business, right, to the rest of the countries in the world. So I do think that because of this influence, you have no choice but to pay attention to it, right? And even if you talk about buying American goods or American brands, like our Apple iPhone is made in China, right? Our clothes are made in China.
Yes.
Probably everything that you see in this set is made in China, right? So because of that scale and influence, I do think that we have no choice but to really pay attention to it.
And Constance, you're a young investor, right? So for yourself, have you started investing in China markets before?
I do trade in the China market, but I'm trying to actually put more of China stock market into my portfolio. Reason being is that first, it offers diversification for young investors like me. Second is that compared to the US, where it's kind of priced at a high price, personally, I think that China currently is priced at a bargain price per se.
Okay.
Yeah, so I think that's where I want to invest in the China market. And also the third reason is because I felt that the China market is an emerging market. So they are like the leaders in, let's say, manufacturing your EV car batteries as well as the AI. So that's where I believe it's a great place for investors to invest in.
Okay. So you do have some experience before that, right? Investing or trading in the China market.
Yes.
And based on those experiences, how is it different or similar with your initial perception of the market?
So compared to the US market, which is something that I'm more familiar with,
Yeah.
the China market is actually mainly dominated by the retail investors. So 70% to 80% is actually retail investors. Whereas in the US market, it's mainly dominated by the institutional players.
Okay.
So this is very different because it's more volatile in comparison to the US market. Additionally, with China market being more influenced by the government policies and the government themselves, it caused more volatility in the market in comparison to US market.
Okay. So really, indeed, in the last couple of years, actually, there has been many events that have happened in China that has impacted both the economy and also the stock market. So let's take a look at some of these key major events. And I believe when we are doing so, we can't run away from going back to the end of 2020, where we saw the regulatory crackdown of the big tech companies in China. So Alvin, could you share with us a little bit more about what actually happened? And how has that actually impacted some of the businesses there?
I guess investors have always been very comfortable with the US environment where the government doesn't really do a lot of intervention in the stock market, right? So when it comes to China, we must understand that it's a very different kind of economy, different kind of style of governance. It's very top-down. It's not like America is more bottom-up. You let the companies do what they want, and then eventually because they compete, you emerge a champion, right? So they really let it to be free market. So in China, because of the top-down, they always plan where they want to advance the economy, right? And that also gives them a lot of power, right? And if they see something that they don't like, they would, of course, intervene And this is a feature, not a bug of the Chinese economy. So I guess that from first principle, we must understand that it's different. So which means a lot of the US investment literature, you cannot just apply 100% to China. It doesn't work that way. So back to that issue was, of course, nobody knows exactly why the Chinese government started to do that tech crackdown, right? And they chose Alibaba as the first target or end group. Many link it to because Jack Ma said something audacious during his speech in the Shanghai summit. We will know, right? Nobody will know the real reason except themselves.
Yes.
And that triggered a series of tech crackdown, not just on Alibaba, but the rest of the tech companies, including Tencent, right? Including controlling gaming for the miners. If you take a look before this incident, it is not the first time. They have regulated peer-to-peer lending before, because peer-to-peer lending has a lot of defaults, and a lot of the men on the street are losing money, right? So they intervene. There was a period where they intervened on mining, right? Illegal mining and things like that. So it has been a feature and not a bug. So I would say that it is because tech become a very popular investment and people start to focus on China as well because of the rise of China narrative. And it just happened that they caught in a crosshair, right, when that happens. So now, at least the good thing is that it's pretty much over, right? The government has also came out and said that they are supportive, right, as long as they behave.
Yes, you're right. So following this regulatory crackdown on tech companies, after that we also have other major events like the property market slump. Then there was the weak consumer consumption domestically in China. So maybe you can elaborate more on some of those as well.
So for China economy, largely is driven a lot by the growth of it has been driven by property investment. Right? You know that not just the Chinese, but Asians in general love properties. Even in Singapore, we love properties. A big part of our assets are in properties. So it's no different when it comes to China, right? And that is not a very sustainable and healthy growth of, say, a developed country, right? You cannot be driven mainly by property speculation. And prices have been going up and up and up.
Yeah.
And places like Shenzhen was even more expensive than Singapore properties, right? And yet the GDP per capita is so much lower than Singapore. So how can they afford that, right? So eventually it has to burst.
Like a bubble.
So I guess the government decided, I don't know, they look at some feng shui or what and say that now is the time to burst the bubble. The bubble has been forming for many years, but no one in power before Xi Jinping was willing to clamp it down until he took the high-handedness method to really burst the bubble. So that, of course, triggers a real estate crisis, right? Developers were too aggressive, expanding, buying a lot of land, using debt, go into trouble, and that trouble is still lingering. The only saving grace is that it didn't become a systemic issue in the financial industry. The banks are actually doing very well, even though the developers are defaulting, right? It's more of the confidence of the investors in the market, because those people get hurt are the bond investors of these developers' companies. So, and Chinese, they also tend to be very pessimistic about future, right? When they are pessimistic, they will save more money. And if you take a look at the data, the savings rate has been going up, right? That's why they're not spending enough. Okay? When they are worried, they don't spend, they save. Okay? It's very different again from the culture in the West. The culture in the West is spend first, we think about it later. Right? So their savings rate are usually very low and they have a lot of credit, right? A lot of debt. So it is because of this culture again, that's why China probably spiral into this consumption issue.
Right. So there are really some risks and challenges that we see right now in the China market. So for Constanz yourself, any one of that you are particularly concerned about, whether is it back then or even at this moment in time, if you're looking in China?
I think the concern would be volatility.
Volatility, okay.
Yeah, so you do not know whether when as an investor you would like to plan properly, correct, before you invest into a certain stock. However, with the government intervention, you do not know whether will it affect your plans. So I believe that's one of the concerns for me.
Okay, so given this current landscape, right, coming from the investment point of view, Alvin, would you see this as an opportunity or a potential trap, investing in China?
It's definitely both, right? So risk and reward is always double-edged. Okay, so definitely from a surface level, if we look at China, yeah, it's risky, it's volatile, the government can intervene, and you don't know what they're going to do. And they're always at the crosshair of US now, right? With all the tariffs that may potentially come. And they're always seen as being at a backseat, right? Even though they're the number 2 economy in the world, but it seems like they are just in a very bad position domestically and geopolitically, right? When we look at international relations. And that is a surface level risk, right? So some people who prefer we just avoid China altogether, right? So they even have like memes for it in the finance sector, if I can use memes. So they talk about ABC, right? Anything but China. Or in the past, usually when we talk about fund houses, they will talk about Asia Pacific x Japan. Now they're talking about Asia Pacific x China. Right? So that is the surface level, and people just avoid altogether, right? It's simple, okay? Because anyway, the market is not doing well. It's not inspiring confidence. Why would people be very willing to invest in it? If we dive deeper, of course, we cannot look at China market as totally uninvestable. There are pockets of performance actually. If you focus on the dividend payers in Chinese stocks, right, you would have done actually pretty well over the last few years. If you look at MSCI China, right, which consists of a lot of stocks, diversified, they will have lost money in 2021, 2022, 2023. Right, not only 2024 they made a positive return. So 3 consecutive years of negative return, double-digit negative return. How many people can take that, right? So people will say it's uninvestable. But if you take a look at the CSI dividend index, that 3 years actually a positive return, total return inclusive of dividends. So that is the difference that I think that there are pockets of opportunity. And last year, if you stick to the dividend theme, that index went up more than 40%. That is even higher than S&P 500. But I guess because the media don't report to that level of depth, right? So you only see the surface level. And I also get a sense because Western media tends to be biased against China, and they tend to cover the negative side rather than positive side. So there are positive things if you look hard enough.
Yeah, and especially right now with the government policies that seem to be more forthcoming.
Yeah.
So with more government support, and hopefully things will start to improve. In fact, the consumer sentiment in China is already at the rock bottom, right? So if we look at it from a contrarian point of view, then that could be a potential turning point as well. And previously, you also talked about how the consumers in China, they tend to save a lot, right? And that's, yes, actually historically, they have been like this
Great
already.
savers,
Yeah, so on average, based on statistics, an average household typically save, I believe, 30% of their income for Chinese, average Chinese household. And this is actually higher than what we see in, say, in the US or other countries as well. So it is not that they are not earning, but it's just that they're not spending it, they're saving it. So the government wants to push the people to be spending more, and that's why they have things like, vouchers, subsidies for them to buy more electronics, things like that to spur the consumption, right? If you look at the consumption as a percentage of GDP for China, it's, I believe, about 40% or 50%. But for US, it's close to 70%, which actually means to say there's definitely a lot of room for growth in China as well, for this domestic consumption to become another new engine of growth. Right.
I guess I'm not so optimistic that Chinese will spend as much as the West, right? Maybe increase another 10% possible, but solely relying on a very domestic consumption economy is just not in the blood of the Chinese, right? The Chinese are savers. For thousands of years, they are savers. You cannot just because of policy change, you make people spend money. I don't think vouchers will help to a certain extent, but I don't think they will change the entire DNA of the Chinese population. China talk about dual circulation, right? They want to rely less on exports, and they want domestic consumption to come up.
Yes.
But, it's a very nice vision, but I think it's very hard.
It takes time, right?
Yeah, it will take time. I will still believe that China will have to rely heavily on exports.
And one good point about investing in China, I believe also, Constance, you raised it right at the start, is for diversification, because historically the Chinese equities, they have a lower correlation with other equities of other big markets like US. So there is also diversification for portfolio risk, right? So we talk a lot about all this risk, opportunities. So given this risk and opportunities for beginner investors who are looking to dip their toes into the China markets, Alvin, what would you suggest are some possible strategies that they can consider adopting?
Usually via ETFs or funds would be the easier approach because you don't need to pick individual stocks, because then you will be subjected to risk that the stock or the company may get regulated or targeted, whatever means. So having a more diversified approach towards China may make sense. And based on my observation, right, so dividend stocks tend to do better, right? So maybe a dividend-oriented strategies using ETFs or funds may be a very good approach as a first approach for beginners.
Actually, for Constance, when you first started investing in China, right, did you also use ETFs or you went into individual stocks?
I think I do a mixture of both.
Okay.
So as Alvin mentioned, I do agree that ETF is much it's better for people who don't have the time to stock pick
Okay.
and also don't have the time to actually be on the market, meaning they don't know any changes, any regulations, because it can automatically help you to adjust your portfolio in a sense. For me, I do both because stock pick allows me to try, because I still have the bandwidth to actually give it a try, right? So
Yes. And especially where you're still young, right? You have a long runway.
yes,
Yeah, you still can actually try it out. Even if you make mistakes, right, at the start, you're
correct.
probably dealing with, let's say, a small amount of capital, right? Any mistakes is still more bearable as well, right?
Yeah, and also to invest, maybe we can put a small portion of it instead of going all out inside. So can dip your toes into it and also do some back testing also. So there are many I think platforms for you to actually try to back test, like TradingView, to let you know whether, hey, is this stock suitable for me? Is it in my risk appetite? Is it suitable for my current portfolio? So yeah.
Right.
If not, I know that some people right now, they're also relying on robo-investors to actually help them manage their portfolio.
Yeah.
However, there's a fee that they have to know, which
Yes.
may eat into their profits.
Yeah. If I could use an analogy, right, to further add on to this, it's like, in investing is actually very similar to playing sports, isn't it? So, for example, let's say tennis, right? There are many ways we can win a tennis match. For professionals, they probably will focus on, I want to play very powerful shots, very strategic shots, so that my opponent cannot hit back, right? But if today you are an amateur player and you don't have that skill set yet, you don't have the ability to be playing such shots, then you probably don't want to be just blindly trying your luck, right? But instead, you want it to just play it smooth, make sure, okay, it can be a simple shot, but it goes over the net to my opponent. I try to reduce the number of mistakes on my side. Hopefully, the opponent is the one that makes mistake and I win the game. So similarly in investing as well, if like what both of you mentioned, if the investor doesn't have the skills to pick the individual stocks, then rather than just blindly invest based on your gut feel, based on what you hear say or on the net, right, which would definitely be of higher risk as compared to, say, using an ETF where the ETF manager has really helped us to pick, and maybe you can just focus on, say, a broad market exposure, right? So on top of ETFs, what other strategies, Alvin, can beginners also look at as well on top of that?
Again, I guess, as I shared just now, dividend focus.
Dividend focus, okay.
Generally in Asia, not just in China, the value dividend play tends to be somehow better, right? I don't know why, right? Probably it's because of the culture of the investors again. You just like to see cash come to your bank account. It just feels good. Growth typically in Asia also tends to be slower compared to, say, the Western companies. So I guess in the West, the investors have the appetite for growth, right? They like to invest in growth. So the growth companies tend to get more love, say, right? And it could help because the consumption is higher, right? So if you talk about consumer businesses, high growth, they may pick up a lot faster, right? Whereas in Asia, it's very fragmented. Growth after a certain time for Asian companies, they might slow down faster than, say, a American company. Right? So probably because of that, the matured stocks that give dividend value kind of opportunities may be better. Because I also see that a lot of people try to do growth in China, don't do very well, right? Generally speaking, right? And one of the biggest disappointment will be Alibaba. Right? It's the elephant in the room that is hanging there. It's supposed to be a growth stock, but now it looks more like a value stock. Right? So I will still think that it's rather better approach to use value or dividend in Asia, including China.
For example, you talk about Alibaba, right? Or even some of the other platform tech companies. So given that now, yes, they are really beaten down, low valuation, then would you see it as, on the flip side, opportunities, given that...
So it becomes a value stock, right? So which means you use a value strategy, you might pick it up. But if you use a growth strategy, you will pick it up at a high price. That's where I'm coming from. So value tends to do better.
So other than the stocks or ETFs that are listed, right, in say in the China markets, here in Singapore locally on our SGX market, are there any counters that we can also consider looking at as well?
There are a lot of Chinese companies that are listed on SGX, and of course there are good ones, there are bad ones, right? So even if you look at within the blue chips, the STI space, Yang Zijiang, right, is part of the STI index, and share price has done very well over the years. One of the largest shipbuilders, right? And I would say it was a dividend play. Dividend yield was rather high as a Chinese company. There are also other smaller caps, right? So the Chinese company that are listed in Singapore tends to be the smaller ones. And the good thing about smaller ones is that rather than the disadvantages, is that they tend to be undervalued. Yeah, because less people look at them, less people understand them, and less people trade them. So the price discovery for these stocks are weaker. They are very deep value kind of stock where they may be trading below their asset value, right? I don't know whether I can give an example. One example will be like China Sanxin, right? It's a rubber accelerator, rubber chemicals, right? If you want to make tires, you need that kind of chemical to harden it. And they are one of the bigger players there in China, even though they are still considered a small cap, trading at very deep value and high dividend yield as well. I would say moderate dividend yield. So there are definitely opportunities, and I would say recently there's also introduction of SDR, right? The Singapore Depository Receipts on Hong Kong counters. And this is an opportunity for people to size their position better, because let's say if you buy a BYD or a Tencent in Hong Kong, it will cost you 5-digit, right, Sing dollars. And if you get the SDR version, probably just a few $100, you can get exposure. So it allows investors to size their risk better. So I would say that there are, and there are also ETFs, right? China ETFs that are listed here by a couple of fund houses, and those are also easy ways to get access to China if they don't have individual stocks.
I see. Right. So on top of identifying the potential opportunities, I believe also in investing is very important, or if not as important, to be taking care of our downside risk as well, right? So coming from the risk management point of view, then perhaps investors will also like to make sure that they keep track of what's the percentage allocation that they want to put into China equities versus other countries. For some people, it could just be a 5%, then the other 95% in some other places. Or for others, it could be say 50-50 or even more, right? But at the end of the day, it's a number that each individual investor has to pick out based on your conviction, your comfort level with the volatilities like you mentioned as well. But what's most important is it's not just about the number, it's more about risk. Because if I put 5%, that means to say that's the maximum I will lose if everything goes to zero. So risk management, that's another thing that beginner investors can also look at, right? Yeah. So then moving forward, in terms of any other areas that they can actually keep a lookout for as well for investors, say currency risk or so on. Maybe you can share with us 3 quick tips. Any other areas to keep in mind of for investing in China?
First would be understand the government policy, because it is a top-down, right? You need to know where the government interest is going to be. Invest alongside the government direction and not go against it. Because if you go against it, then regulatory crackdown is going to impact the companies that you invest in, more likely than not. Right? So go with the flow. So it's important to pay attention to what the government plans for the next few years. They usually have this 5-year plan, right? So the good thing about top-down economy is that the plan is laid out in front of you. So you know where the government is going, where is it prioritizing, right? So at this point, you know that boosting consumption is one. Right? Whether they, of course, the other side is whether they can achieve it is another story, right? But the point is still understand where they're going and invest alongside that direction. So clean energy, right? Transition, a lot of semiconductor stuff, right? So these are the areas that maybe they will get more help from the government, right? Of course, case by case, company by company, the performance may vary. The devil's in the details. Another thing would be, I would say, maybe look at brands that people are familiar with, where you have touch point with those Chinese brands. Because a lot of people will say that, I don't know China well, I don't receive a lot of information, I don't know where to find them, right? But I believe that there are enough Chinese companies that we have more touch point with, right? Like, I don't know, Labubu, then you think of Popmart lah, okay? So having focused more on the consumer brands may help, right? Rather than look at some esoteric industrial company
that you don't even know
B2B,
about,
you don't even know what's going on, right?
Yeah.
So you won't develop a confidence anyway, and you just buy blindly. I don't think that is a good way lah. So maybe start from a consumer standpoint, where the touch point is and where you see the potential. Maybe a good avenue to start with. And then third, in terms of finding information, the information is there, is actually there. But I believe that most people have never really looked at the A-share, especially A-share. They usually look at, maybe they talk about China is H-shares, right? But H-shares reporting is very different from A-shares reporting. A-shares reporting, the format of their statements or the annual report, they follows a US GAAP a lot more. It's a modified GAAP for China. So the details is actually a lot. But unfortunately, it's in Chinese. So most people was, cannot. This is giving me a lot of headache. 200-300 pages in Chinese, right?
Especially in all the financial terms, is even more difficult.
But the thing is that given the current technology age, you can just easily translate the entire PDF into English, and it looks like just an English report. And people just don't want to find, but they'll just say that information is not available, it's opaque, but it's not true. So I guess these are the 3 tips they can think about.
Yeah, and also probably don't over leverage as well, areas like this. Because back then in October last year, right, that was where we saw the very fast and huge wave up for the China market. So in China, there are actually a lot of very massive influencers with massive following. So they were talking about how this is a chance to build your generational wealth. And then some people, the followers, right, after they listen to it, they may just blindly follow or even take out leverage. Because the problem is when people do leverage, they will think about, okay, if it goes up, then what's my potential gains? But many times we forget to look at the downside. What happens if the market doesn't move in the way that I want it to be? Then what are my potential losses? So again, it's back to risk to reward as well. So these are some of the key areas to look at. And given the high volatility, it requires a lot of emotional discipline as well, right? Isn't it? As an investor in a Chinese market. Yeah. So pullbacks, all of this are actually natural and part of the entire journey. Or even at the start of a new bull market, usually people will fight. They will say, oh, it's probably just a bear market rally. There will be lots of articles, headlines that talks about that as well. So those are the expectations to expect along the way in this journey. Yeah. So
I would say for leverage, it don't just apply to China, it applies everywhere else.
Everywhere, right? In fact, for emotional discipline, it also applies everywhere.
Yes.
It's just that
it's not like US stock is not volatile.
Correct,
it's also very volatile.
Right. But probably maybe in comparison, there could be maybe in this period in time more volatilities in the China markets. Yeah. So on this aspect of just now you talk about dividends, right? So for Constanz yourself, when you were looking at the individual stocks, were there any particular industry that you were more focused on?
I think I'll be more focused on the your car manufacturing, like your BYD companies, your AI companies, those companies that it's a China company brand.
Yes.
Yeah, so I think that's where I will focus more on that because I'm aware of, there are these companies that I can look out for and they are more prominent.
Okay. So those are the areas. On top of that, so are any other particular industries that you can point out as well, Alvin? As well as any emerging trends in China that we can look forward to in the next upcoming years ahead?
I would believe that the state-owned enterprises will have advantage again because when the national team, right, the China national team, we're supposed to simulate the stock market, they will tend to buy the ETFs. That has been the behavior since last year.
Yeah.
They may also buy directly the individual stocks. It is very high tendency that they will buy the SOEs, right, the state-owned enterprises, rather than the fully private enterprises. And the ETFs, a lot of weightage will go into, say, the banks, the energy companies. So these are again SOEs company. So I believe that the good performance of this company last year may be a result of because this liquidity is pumping into these company stocks. So there could be this continuation of uptrend for this kind of state-owned enterprises in probably the next 1-2 years as the Chinese national team continue to pump more money into these companies.
Right. So at this juncture, right, for Constance, do you have any other burning questions that you want to?
So we talk about investing. So my question would be, would it be better to invest in the shorter term or longer term, and what time frame are we looking at?
It depends on the individual strategy, right? So it's definitely more important to have a strategy than without a strategy, using gut feel, whatever, right? So whether it's a short-term strategy or long-term strategy, I think it's fine. But of course, the kind of strategy, if it's short-term strategy, the kind of stocks that let's call it a trader, the trader is looking at may be very different from the person who is doing a long-term time frame, right? So for example, a long-term time frame guy is mainly what we have been talking about so far, the more dividend value focus kind of strategy where you can hold, right? Because especially dividend, if you sell, you're not going to get the dividends anymore, right? So they typically hold a longer period of time, and it's more suitable for that kind of strategy. Then for short-term trading, then probably, anything that trends up very nicely, like PopMart, all these kind of stocks may do better, right? But they may not be something that you want to hold long-term. Maybe at one point the price will collapse, right? And then you lose a lot of money. It could be short-term, you are really very, very short-term, intraday or a few days. Then intraday volatility is very important. If the price don't move a lot in one day, then it's tough. Unless you do DLC traded on SGX, then maybe that's possible. You leverage 5-7 times within a day, you go in and go out, right? But again, you need strategies to properly extract the alpha of it. Otherwise, it's just gambling.
Yeah, I agree. The strategy is important. If you're looking at dividend, like you say, then you definitely have to hold on to it, right? So for example, myself, personally, what I do is I do actually, it could be a company that I believe is fundamentally sound. But I may not say hold it for the next 5 years or 10 years, but I may buy at a good price and eventually I offload them, say when it's nearing a resistance or things like that on the technical charts. So that is my own methodology where I will just shift the capital around. So I believe at the end of the day, it also depends on what kind of strategy that you have, because it is the same stock market, but then the strategy will determine the kind of returns that you get for your portfolio, right? And of course, you don't just blindly do it based on what people say, oh, I'm buying now, I'm selling now, but whether you have a strategy in mind and why do you choose to sell it? Why do you choose to buy it at certain prices? For example, for myself, I could have sold it at a good price and then eventually I move it into some other stocks. It can be in China, it can be in US, it can be in Singapore for a dividend play and so on. So it all depends on your strategy. So myself is more tactical. So then that is why I'm looking at something like that. But for someone who perhaps wants to just be more passive about it, then maybe a focus on the dividend stocks might be the way to go. So there are actually many ways in which you can actually go about doing it. Yeah. Any other questions that you have?
Understanding that China currency, right? Is China still investable?
With regards to the currency.
With regards to the currency.
Okay. So the currency is a bit different, right? So for China, they control the interest rate, plus they fix the currency exchange rate, right? That's why they cannot allow capital outflow, free capital flow, right? So this is called the Trinity dilemma in economics. So you can only choose 2 out of 3. So US, they control the interest rate, they allow capital flow. That's why they cannot fix the exchange rate. The US dollar has to be free floated. So every country has to do that. So China monetary policy is a bit different from the US. And how they manage the exchange rate is that every day they will have a middle point, which the central bank will say this is the middle point. And they will allow some fluctuation, daily fluctuation above and below it. So because of this fixed rate, you don't know where they're going to fix everything. So if you want to trade the currency, that's the risk. Right? You need to somewhat, get into their, have some information or some really good projection that where they're going to fix the rates. Right? So that's the part when you want to trade China currency. Right? It's unlike others are free float mostly. Okay. Then in terms of the long-term wise, right? Let's say we talk about currency strength. The issue is sometimes you invest overseas, the stock may be going up, but then the currency is depreciating, right? So especially our Sing dollar is typically very strong against a lot of countries' currencies. there's a tendency that you will always see some forex loss in your foreign investment, including even US stocks. So the trend now is that we understand China is going to stimulate the economy, right? And that means that they are likely also to cut interest rates, right? Because they control interest rates as well. And then interest rate will have an impact to the currencies. So lower interest rate will mean that the currency will weaken. It's very hard to defend a currency when there is less demand for it. So they need to balance this, but the direction is that it's very likely that renminbi will depreciate for the next few years, right? To stimulate the economy and to allow that interest rate to go down. So I would think that is the direction. Be prepared for more yuan depreciation in the next few years.
And on the various social media platforms, right, it's very common to also see comments like, when the market is going up, we'll see comments like, oh, I've missed the boat. Okay, then when the market is coming down, then there will be comments like, oh, but I'm afraid of investing in it. If I invest, maybe I might lose money. So to such comments, Alvin, what would you have to say?
Don't invest, huh?
Don't invest. Because the mindset is not even set right for investing, right?
Yeah.
That probably means to say that the person who's leaving such comments, you don't really have a strategy on what to do, right?
Either try enlarging that comfort zone, right? You invest what you are comfortable to lose first. Maybe it's a very small amount, right? Then once you get comfortable, you increase the amount gradually. Right? So that's what I call the psychological capital. A lot of people talk about investment is your financial capital. But the psychological capital is how much money can your psychology take when your money is at risk, right? So very few people pay attention to that. Some people have it very small, some people have it very big, right? Too small, you're too conservative. Too big, you're a gambler. And therefore, it is a balance, right? So not to be too gung-ho about it. If someone is really very conservative, then just start with something that's easy first, maybe even a money market fund that you can't really lose money, or a investment grade bond fund, right? That's something that has lower volatility, right? Maybe don't go into stocks straight. You can invest something that is rather safer.
And probably if you make such comments, you don't really have much conviction, right? And confidence in the stock to begin with. That's why you don't dare to go in when the prices are good.
But clearly the desire is there. That's why
the desire
they want to
money.
do it. Yeah, they want to do it, but they are scared at the same time.
Yes,
right?
yes.
So I guess start small.
And also because the problem is people just look at returns, right? So they only want returns, but they are afraid, okay, lose money. But actually having paper losses in your portfolio along the journey is something that's part and parcel of the entire journey.
And I think it's quite risky to actually have that mindset, because you kind of like are FOMOing. And
yes, FOMO.
At a point of time when you have such a mindset, sometimes you might actually like want to revenge trade. And that would even cause your losses to even be much larger. So I think that's quite a risky mindset. So I think before they even invest, they should really calm themselves down, really think about their strategy, understand, are they able to take on such a risk? And also maybe do some backtesting, like paper trading, like you mentioned.
Yeah, so investing is not just about the strategy, but also the psychology part.
Yes.
A combination of that in order to be a successful investor.
But right? Some people do it for the thrill. It's not really to make money. It's really like
then that's more like
treat it like a casino. Like you're buying entertainment. If you're buying entertainment, it means you're spending money. Right? So they just don't get involved. They feel the excitement of it. So of course, again, this is a very wrong psychology
very risky,
to have. Yeah.
Yeah, right. So thank you, Alvin and Constanz, for sharing with me your views, right, as well as your past experiences on investing in the China markets. Definitely, there's a lot more to explore in this China markets, and hopefully in the upcoming year or years ahead, the dragon will finally be awakened, right? And we will see more progress in the China
Dragon
market.
year is over, now it's a snake.
So that means even less chance.
I don't know, man. I don't know. I'm not a feng shui master, but definitely a snake looks smaller than a dragon.
So is investing in China markets worth the risk? For some people, the opportunities could outweigh the risk. But again, it's not a one-size-fits-all approach. If you are starting out, it's essential to do your proper research, understand more about China's unique position, its unique challenges, as well as the opportunities that it may be able to offer. And at the end of the day, it's essential to navigate through such a market with a clear strategy. Until next time, keep your FOMO in check, stay informed, and happy investing. Catch us again in the next episode of the FOMO Fix. Okay, thank you.
Okay, thank you.
If you're feeling fired up and ready to dive deeper, feel free to hit us up. Leave your comments below. We would love to hear your questions and topics that you would like us to cover in future episodes.